The 2023 housing market is insane right now. It is insane because of two things: mortgage rates and high home prices. Now, the high home prices is completely a supply and demand issue because the last 2 years money was made so cheap, we were willing to pay higher prices for those homes. So when you pair high mortgage rates with high home prices, what you have pretty much is a debacle. Especially if you are living in a high cost area, you have an even more problem. And when you pair that with the fact that institutional investors are buying homes by the boatload, we have an even bigger problem. So I created this video because it's so critical for you guys to be equipped and have the tools to calculate your own debt to income ratio so you can create your own home buying goals within the privacy of your own home. You don't have to feel obliged to connect with a lender or a real estate professional. You can do this in your vision board, your family meeting, whatever, because the economy is shifting at a fast pace. And so if you are a renter, and like I said, if you are a renter in a high cost area especially, you want to be able to work on your goals at any time you wish. So without further ado, let's dive into this video. And of course, if you guys have any questions, make sure you drop them below. If there's any sensitive information that you like to discuss, my contact information is in the description below. So your debt to income ratio is a uniform calculation that is used by your mortgage lender to see how much money does this person have left over after they pay the mortgage and after they pay all of their debt. And of course, generally, the lower your debt to income ratio, the more of a good looking borrower you are. The better your rates, the better your fees, the better the underwriter's not going to be all in your business. Whereas a higher DTI, you do pose as more of a risk to the bank. However, as long as you fit within the limits, you are good to go. Before we get into all these juicy details, let me give you guys a concrete example so you can paint a picture of how much the mortgage rates and the home prices are really affecting people. It is mind-blowing, okay? For example, let's say you are looking at a $500,000 house in South Jersey. $500,000 house a year ago, you take your mortgage insurance, you take your homeowner's insurance, you take your property taxes. That $500,000 house a year ago would have been about $3,100 all in. That same house today, not even taking into account the fact that home prices are up 12% versus last year in Burlington County, the mortgage payment on that exact same house will cost $4,000 today. $4,000 today versus $3,100 a year ago. I would have went over asking price too. I would have went over the appraised value too. The home prices are up 12% year over year anyway. $900 is a lot. We're not $100, $200. I mean, people spend $100 at the liquor store. $900, that is a lot. That is significant. So let's take it a step further so I can show you how the DTI comes into play. Let's say you have $100,000 income and you have moderate debt. You have a nice car in the driveway, a $700 car note. You have student loan debt like the rest of America. I won't digress. Let's say you have $100,000 in student loan debt. We have to account for that, which we'll dive into in a second. And you want to get pre-approved today. And you have the exact same debt to income ratios, which I'll share how to calculate those here in a second. Your financial profile will only get you a $380,000 house today. That is a $120,000 difference. I'm sorry, you guys, but that takes you from Target to Walmart. That takes you from Mercedes to Toyota. That takes you from this neighborhood to the next neighborhood. $120,000. I don't care if you're in a high cost area, if you're in freaking Alabama, $120,000 difference is a very big difference. So that is where home affordability has gone in just a year. So let's get into how you can stay ahead of things let's dive into this DTI. So first, you're going to want to calculate your monthly income. We use your gross income, the income before taxes. So if you are a W-2 employee, let's say if you are hourly, you're going to take 40 hours times your hourly rate times 52 weeks. Divide that by 12 months. That is going to give you your monthly income. If you are a salary coworker, divide your income by 12 to create your monthly income. If you are commissioned, you're going to want to take your last 1 or 2 years of W-2s and divide that by 12 or 24 months. If you are self-employed, check out my video where I went into great detail on how to get approved, how to calculate your income. Now, for the sake of this video, let's assume that you have an LLC. You are going to look in your tax returns for your Schedule C, and you are going to take your net operating income for the last 2 years and divide that by 24, and that is your monthly income. And of course, you want to include any additional income that you may receive, whether that's child support, pension, alimony, disability, etc. Now let's move on to accounting for all of your debts. Now we want to include all your debts that are on your credit report, and even the material ones that are not disclosed in your credit report. You guys, I did have a home buyer who has a Tesla, and for whatever reason, the car payment was not on the credit report. So I'm like, Elon, what's up with that? You want to disclose even if something's not on your credit report, whether that's a child support obligation, or maybe you have some type of payback, some suit, or some type of installment loan, you absolutely want to disclose that because it will come up somewhere during your mortgage process. So liabilities that are found on your credit report are things like credit cards, car loans, mortgages, student loans. And let me touch on that real quick. You guys, student loans are absolutely part of your debt, even when they are deferred. I swear, I feel like every consultation, I'm like, hey, so what kind of debt are we working with? People always say credit cards, and sometimes they won't say car loans, and they definitely never say student loans. So then I say, hey, what kind of student loans do you have? So they'll say, well, I do have student loans, but they're deferred or in forbearance. And I'm like, that counts because that is money that you have to pay at some point in your life. If your student loans are in a deferment or a forbearance state, we will take 0.5% of your total student loan balance and account that in your monthly debt obligation. So before you walk through an actual exercise, let's talk about the debt to income ratio. April, what the heck is the front end? What is the back end? What's allowed? What's not allowed, etc. 2 components to your debt to income ratio. You're going to have your front end and your back end. Your front end debt to income ratio is the easiest to calculate. Your back end debt to income ratio is the most important number to calculate. Your front end ratio is your proposed mortgage payment divided by your monthly gross income. For our scenario, we're going to use the most flexible loan product, which is an FHA loan, because the most flexible loan product allows for the most purchase power. An FHA loan, the guidelines state you can go up to a 47% front end debt to income ratio. What that means is your proposed mortgage payment cannot exceed 47% of your gross income. So if you make $100,000 a year, divide that by 12, that gives you $83.33. You take that number times 0.47. That means your mortgage payment cannot exceed $3,900, no matter what. It doesn't matter if you have additional debt. It doesn't matter if you have no debt. It doesn't matter if you have an 800 credit score. And then we have your back end debt to income ratio, where we'll take your proposed mortgage payment and the total of your monthly mortgage obligations. When you take those two combined, they cannot exceed 56.9% of your monthly income. And that is an FHA guideline. That is not lender specific. So now that you guys know the limits on your front end ratio, the back end, what it means, we have your income, we have your debt. Let's dive into this spreadsheet. So let's start from the top and enter our income. Let's say we make $100,000. Then we're going to enter our monthly debt obligation. So we have $700 on a car note, $100,000 in student loan debt. That our student loans are deferred right now, so we can take the 0.5% and create a monthly obligation. Then we're going to take the property taxes for our area. Now, for example, in Burlington County, the property tax rate is around 2%. So you can always hop on Zillow and take a look at homes in your area to get an idea of property taxes in your area. So we'll just put $8,000 here. Homeowners insurance is typically around $1,200. Now, keep in mind if you are in areas like Florida where because of the weather, homeowners insurance is pricier, as well as a lot of places do require flood insurance in Florida. So you might want to hedge yourself and bump it up a little bit. Then we're going to adjust our down payment. We're going to use a 3.5% down payment. And then we need to adjust the mortgage rate. Right now, mortgage rates are falling between 6 and 7%. Now, here's a disclaimer. Keep in mind, this is only for illustrative purposes only. I do not want somebody hemming me up like, April, you said rates were 6%. The spreadsheet automatically calculates your mortgage insurance premium for you. Now, anytime you put less than a 20% down payment, it is a federal guideline for a lender to charge you mortgage insurance because it protects the lender in case you default on your loan. So we have our mortgage insurance in here, we have our rate, we have our down payment, we have our income, we have our debts, we have insurance. Let's mess with the purchase price a little bit. And as you can see, the front end ratio and the back end ratio will calculate for you. That lands me at a $420,000 purchase price. $420,000 purchase price. That is going to give me an estimated mortgage payment of around $3,500 all in. And now that you know your purchase power, you can just hop on a Zillow and, you know, if you're up late at night, now you have an idea of like, ooh, I can qualify for this house. Ooh, like, babe, look at this house. You can start manifesting, sowing those seeds on the home you're about to buy. That is the whole point of this exercise, guys. It really is. If you want to take it a step further, by all means, check out my 3% down payment conventional loan program where you may want to just get pre-approved today. I don't know. Be sure to like and subscribe if you would like more mortgage updates. By all means, if you could share this video with a friend, send it with a picture with a note. I don't know. I so appreciate you guys for watching my video and supporting me. And until next time, I will see you guys next Wednesday.